Hello everyone, my name is Mark Newman. I get a lot of questions from people who are either going to business or establish an existing business about what's the most appropriate structure for them to operate through. So accordingly, I've prepared this series to cover off some of the advantages and disadvantages of four of the main types. The first one I covered off as operating as a sole trader, then as a company. In this one I'm talking about operating as a trust, particularly a discretionary or what's also called a family trust. And then finally I'll talk about operating as a partnership. Again, as I've said in all the other videos, always make sure we seek independent advice, as everyone's personal and business circumstances are different, and we want to make sure that we have the most appropriate structure both now and going forward. So what is a family trust? Basically, it's an organisation that is established, that has its own separate deed. It'll operate the business for the benefit of the family members. So the trust itself will have its own tax file number, ABN and bank account. The business income and expenses will go through that bank account. But what we also need to consider, and is very important, is who is the trustee. And why is this? The trustee is the person or organisation that's actually making the decisions on how the trust operates. But in addition to this, the trustee is also liable for any debts of the trust. So in the event that the business was, for example, to go bankrupt, then the creditors can come and ask the trustee to meet any debts of the trust. Now, if this is an individual, any of the assets that the individual owns can then be used to meet the debts of the trust, and that, for example, the individual may have to go bankrupt. Alternatively, if we have a corporate trustee there and it's met all its requirements, then the corporate trustee is liable. And provided that's to have no assets, we can simply wind up their trust and walk away from any debts that are involved. So what are some of the advantages? Well, the main advantage is the ability to distribute profits amongst the family groups. The family group is a very wide definition, and most trustees include spouses, children, parents, grandchildren. Even if they're not on the scene as yet, if they come in the future, they can actually receive tax-effective distributions. Now, one of the things I will point out now is children under the age of 18 can only receive a very small distribution as they're minors. Once they're 18, they can actually receive a full distribution. So what does this mean? What we should also look at when we're establishing a trust is, what's the age of your children? So for example, if you have a child that's 14 years old, whilst they're not tax effective now, they will be in 4 years' time. So accordingly, a trust may be an appropriate structure in future planning. In addition to this, most deeds and trusts allow you to distribute to other organisations, for example, churches and charities. So that may be an effective taxation planning distribution if you're actually giving money to these organisations. Another advantage is if we have a corporate trustee involved, this obviously gives us the limited liability, i.e. the asset protection. So what are some of the disadvantages? Well, there's a cost involved. Obviously, we have a trustee to establish, and if we do go down the path of a corporate trustee, we have to establish that as well, which will have ongoing fees. In addition, a trust has its own financial accounts and income taxation returns that need to be prepared every year. Another disadvantage of a trust is the losses of quarantine. Now, what that means is if the business was to make a loss and the family has actually profits in their own name, the losses have to actually remain within the trust. We can't distribute a loss out of a trust to offset other income, unfortunately. Another disadvantage is introducing non-family members. Trustees are very strict that it must be a family member. So if we want to introduce a business partner in the future, as under a trust you don't actually own a share of the business, we'd have to look at changing the structure around, which can be expensive. And final disadvantage is beneficiaries pay tax at their marginal rates. So depending on what other income they're having, a distribution to a beneficiary may actually not be that tax effective. Alternatively, we can leave the profits within the company, but that pays taxation at the highest rate, which is very expensive. So that's just some of the advantages and disadvantages of operating through a trust. If you have any questions about business structures, please do not hesitate to reach out. Thanks for listening. Mark Newman.